Income Tax 2020. Schedule C, Sole Proprietorship Business, Business Income. Come in, relax with Income Tax 2020. Schedule C, Sole Proprietorship Business Income. When thinking about the Sole Proprietorship and Schedule C, we're going to be talking about the top line item, the income line item of our income tax equation. Remembering, however, that we have a separate Schedule C, that Schedule C having income and expenses in essence being deductions, the bottom line of the Schedule C, in essence, net income, then rolling into the top line of our income tax equation on the income line. Then we apply our deductions both above the line and the below the line deductions related to the Schedule C income. Here's a first page of the 1040. Remember that the Schedule C will have effects on many areas, including this line item for the other income, which is coming from the Schedule C, and then the Schedule 1, Part 1, we have the self-employment tax, and we get half of it will be deducted as an above-the-line deduction, which is also coming from Schedule 1, but Part 2, we then could have an impact for the qualified business income deduction here as well. This is a look at the Schedule C. There's the $100,000 on the bottom line. We're going to be focusing in on then the income line item, the top half of the Schedule C. What's going to be included in income on the Schedule C for a sole proprietorship business income. Much of this information, although the Schedule C is in 2020 and will be working practice problems in 2020, the tax guide for small business is not out for 2020 yet, so we're using 2019 information, modifying it where necessary, but note that we're taking the baseline from the 2019 information. The 2020 should be out shortly, and if you have questions about areas of like a gray area, then you could take a look at the tax guide for small business. You could find it on the IRS website, which is at irs.gov. With regards to income, most of it should be much the same from 2019 2020 with regards to the instructions there. So business income. If there is a connection between any income you receive and your business, the income is business income. So it's going to be like the business related income, of course. A connection exists if it is clear that the payment of income would not have been made if you did not have the business. So it's important to be able to connect the business income to the business. You have the business, anything that's going to be income because you have the business is business income. Now note, you can contrast this, of course, by other types of income which are easy to contrast to, such as W-2 income, where of course you'll be an employee, and you will know you'll be an employee because you will be receiving the W-2 for it. But note, the IRS is concerned that if you have business income of some other nature, that you report it as business income, because if it's on the Schedule C, note that you're not only looking for the federal income tax, but you're also going to be paying payroll tax, basically payroll tax, which is self-employment tax, Social Security, and Medicare. Whereas if you were to report it as something else, like other income somewhere else, then you'd still be paying most likely federal income tax on it, but then you may not be paying the Social Security and Medicare taxes. So note that if it's a Schedule C type of business, you got to make sure that you're reporting the income in the proper place. Oftentimes, it'll be very clear where the proper place will be, such as W-2 income, 1099 income for like interest or dividends and whatnot, versus business income, which is going to be related to the business. But sometimes you can get kind of that in-between area, and you might think, what does it matter? Why does it matter? Well, it could have a significant impact on the taxes, because if it's on the Schedule C, you'll be paying federal income tax and payroll taxes. If you put it into some other income and don't apply the payroll taxes, Social Security and Medicare, that could have a significant impact. You can have business income even if you are not involved in the activity on a regular full-time basis. Income from work you do on the side in addition to your regular job can be business income. So if you have a side job or something like that, then it's like, say you have your normal W-2 income and then a side type of job like gig work, then you will have W-2 income, and you might think of that as your primary income, but that side work needs to be reported basically as business income, typically on a Schedule C, because there is a profit motive to that, and therefore you'll be paying, the federal income tax and most likely self-employment tax, Social Security, and Medicare on it. You report most business income, such as income from selling your products or services on Schedule C or CEZ, but you report the income from the sale of business assets, such as land and office buildings, on other forms instead of Schedule C or CEZ. For information on selling business assets, you can see Chapter 3. So notice, of course, that if you're selling inventory or any kind of service that you have, will, of course, be recorded typically as income when you do the service on the Schedule C. If you sell things, if you categorize them as inventory, when you're selling inventory, in other words, then you're going to have the income that's going to be reported for the inventory that is sold. But you might sell other business-related things that might be like depreciable assets. They're not inventory, but you're selling them, and they were part of the business, and they may have to be reported somewhere else as you record the income related to it, and may then flow through possibly to the Schedule C. Items that are not income could include appreciation. That's going to be the increase in the value of your property, are not income until you realize the increase through a sale or other taxable disposition. So when we think about items that we are holding on to, possibly assets, then typically we have depreciation, like a car or something like that will typically go down in value. But we could have items that appreciate, and that could be something like land or a building or something like that that goes up in value. It's appreciating in value. Now, the appreciation, then, you could think of it as kind of income because the value of the thing is going up. It's appreciating, but we will typically not record the gain on the appreciation until we sell it. So, and that'll typically, again, happen with something like real estate or something like that, which could go up in value. If you have other kind of depreciable assets, like equipment and whatnot, they will typically depreciate, go down in value, and then we might have to record basically the depreciation as they decrease in value, assigning the cost to the period that it was incurred and so on. So consignments of merchandise to others to sell for you are not sales. The title of merchandise remains with you, the consignor, even after the consignee possesses the merchandise. Therefore, if you ship goods on consignment, you have no profit or loss until the consignee sells the merchandise. Merchandise you have shipped out on consignment is included in your inventory until it is sold. So if you have something on consignment, so for example, you might be saying, like you might have a restaurant. I had a client one time that had a restaurant, and they would have people that would put their paintings in the restaurant, and basically then they would sell the paintings possibly from the restaurant if someone wanted to buy the painting. And then, but the paintings, when they had them in the restaurant, were not theirs, right? They're still the artist's paintings that are basically in the restaurant. So in that case, although you have shipped the inventory to somebody else, it's now in someone else's business. You have not sold it to them. They didn't buy it and resell it. They agreed, in essence, to sell it for you at a cost. They're displaying the inventory and selling it. So in that case, if I was to be an artist and put my inventory of the artwork in someone else's facility, like a restaurant, then it would still be included in my inventory, even though it's not in my warehouse, and I wouldn't record it as a sale until the restaurant basically sold the inventory.